Hello and welcome to this edition of Money's Best Friend with me, Vivek Law. Despite the festive season, the real estate sector has continued to face a slowdown with new launches at a 5-year low. According to a recent report, the unsold inventories have only declined marginally in 2014, and this would take more than 2.5 years for the developers to exhaust their unsold inventory. Both end users and investors are worried about their investments in the property market. End users are waiting to see if property prices are going to come down any further. Are you the one who invests most of your money in real estate but are confused when and where to invest? Today on Money's Best Friend, we tell you what are the options that one should look at. To discuss the current state of affairs in the real estate market, joining me now is Pankaj Kapoor, Managing Director at Lysis Forus. Thanks very much, Pankaj, for coming by here on Money's Best Friend. There's been a lot of concern, excitement. As far as end users are concerned, there's excitement. They're waiting. And the big question is, are property prices going to come down further? They've been stagnant for a while now. As far as investors are concerned, there is a genuine concern that is 2016 going to finally see some kind of a takeoff in this sector? So initially, your preliminary thoughts on where the real estate sector is right now?
In fact, if you look at it, it's in the transition phase from the investor-oriented market. It is turning into an end-user-driven market. So it's a time where it is shedding the extra fat and the cost and then trying to be a more efficient real estate. So what has happened in past also, the way the prices surge, they gone so high that the end user could not interact with these prices, and the gap between the purchasing power and the prices increase. So despite we are being a housing shortage country, we saw the inventory rising and the sales dropping. So it's a clear indications that the end user market actually got affected and they could not interact with the increased prices. And since the prices peaked and a lot of investors who invested in past and they looked at the exit, they could not get the buyer to give them a profitable exit, and they need to resort to reduce the prices. And that's where the sentiment related to the investors gone away. So what happened, that the prices became unproductive in past, and that's where the months inventories gone up, sales velocity reduced, rental yield reduced. So it did not really remain as a hugely investors market. But and the last 1.5 year, we have seen that there's a downside pressure in the prices which is built in the secondary markets, especially in the North India and all those things. Prices have already reduced. Because all the investors who are looking at exit, they are willing to really give a discount, and that's also has impacted the sentiment of the market. And since the inventories are very high and sales are not improving, so builders also are now finding it difficult to further increase the prices. So there's a stagnancy in the market, and it has moved into a time correction zones. My own sense is 1.5 year it will continue to be in time correction zones, because for if you talk about 3 years of inventory, 2.5 years to 3 years of inventory, efficient market maintains 8 to 12 months of inventory. That means my sales should improve, and it should improve at least twofold or threefold, and for the sales to improve threefold or fourfold, so either the income should increase or prices should undergo corrections. So the way the cost has gone up along with the prices, it has given very little scope for the developer to reduce the prices. They are waiting for the incomes to grow. So it's a period which is like prolonged period of corrections, where we are waiting for people's affordability getting improved by virtue of interest rates reductions as well as income rise, and little scope for prices to undergo correction. So there would be 1.5 year of prolonged corrections, and time correction I call it, rather than a sharp cut for the prices.
One of the trends that we are seeing, Pankaj, is that while developers are not necessarily cutting down officially the prices, but there is a lot of scope today more than ever for an end user to actually sit down and negotiate and drive down prices in a transaction. Is that something that you're seeing as well?
It is, and it's a buyer's market, and I'm saying that we are moving into the buyer's economy all along. So right from the e-commerce to real estates, it's a buyer who is a king, and the kind of discounts available to each one of them, because developer needs cash flows, and they know that end users have ample options and they're willing to give a discounts. So it's a market where the end user can really negotiate hard and they can get a deal, and there are good deals available in the secondary market because a lot of property which are ready. If you look at the census data, which shows that we have 72% increase in the vacant homes in the last 1 decade, so that means there's a huge ready inventory available which investors purchase, and they may be willing to get a exit in those. So there's enough supply available, primary as well as secondary, so it's a time for them to negotiate. So it's an end user market, I would say that. And the way the interest rate is also coming down, so that's also a clear signs that it's a period which will be driven only by the end user. I do not see too much of investors participation coming by.
All right, lots of questions coming in also. Let's take a few of them for you, Pankaj. There's this mail that we've received from Dr. K. Nitesh. He's from Maharashtra. His question is, I want to invest in a 2 BHK flat in Mumbai, which can give me good returns in the coming 5 years. My budget is around 50 lakh rupees, and 80% of which I will need to take a loan. Please suggest the right areas and projects where I can invest. A little too less, would you say, the kind of budget he's working with?
Yeah, yes, and at this budget, what he will get it mostly into the extended suburbs, which could be around the whole semicircles from the western extended western suburb, which is like Mira Road and beyond, or extended central suburb, which is beyond Thana, going up to Badlapur, Ambernath, or they may consider outer areas of Navi Mumbai, Panvel, those regions. So these are the regions where such kind of products may be available. Now the question is which area he should select and which quadrant he should go in for. So one important aspect is that if he's looking at just the investments, he may consider Dombivli, which is emerging. There's a very interesting scope around Navi Mumbai, but it's all depends upon if the Trans Harbour comes in. We've been talking about the Trans Harbour for last 40 years. Even though in the recent times, like last month itself, government got the environmental clearance norms and all those things. It looks like it's not that kind of a project that which will never happen. It looks like the likeliness of its happening is there. So, but nevertheless, you consider this probability only 50%, don't consider 100%, because last 40 years we have seen at least 8 to 10 times the proposal has happened, but nothing happened post that.
Pankaj,
so
the next 5 years kind of a time frame that he's working with, do you see returns coming in the next 5 years in these pockets?
My own senses, Navi Mumbai certainly looks like, as well as Dombivli, Kalyan, because those are the areas which are interacting. There's a economic activities also taking place, as well as portions of Thana, but because that's where it interacts with the demography of Mumbai, and I see this good economic base which will get developed. But my own sense is next 2 years they should not consider too much of appreciation. Post that it will certainly be.
All right, we have another question for you. This is an email coming in from Ananya from Delhi. She writes, I am planning to buy a property in the L zone of Delhi from a builder. After doing the research, I found out that there are 2 types of properties that are available. One is the builder type and the second is the society type. Can you please clarify the pros and cons of both the properties, and which one would you recommend under the land pooling provisions for the L zone?
DDA has proposed the land pooling, but it is still not notified, and I'm seeing that there are a lot of developers who have come forward and started launching those projects, and the DDA has come forward with the public notices saying that don't be beguiled with these kind of offers from the developers. So very important for you is to see that this policy is not come into the force. So it is not there, it is just a proposal, it is not got notified. So I would not say that you should go forward and purchase within L zone and all those things. Even if any builder who comes forward and tells you that there's a property available in within the L zones, ask them is it approved or not, or not. See the approval plans, because it may take 1 year, 2 years, or it may not get notified for 10 years and your money gets stuck. So I would say that don't really push yourself. There's a huge scope for a development for L zone, because it's much closer to Delhi. So in that sense, there's a huge upside built on that. But don't go completely by your own greed and say that the future appreciation is good, so let me take the risk. You never know whether it will get notified in 1 year, 2 years, or 10 years, or it will not really get notified, because land pooling policy has a huge impact on the markets of Gurgaon and Noida, and there would be several forces which will be working or acting against the impositions of the land pooling policy. So my own sense is don't be in hurry.
Thank you very much, Pankaj Kapoor, for coming by and taking questions of our viewers and sharing your perspective with us. Thank you. It's time for a quick break here on Money's Best Friend. After the break, Sanjay Gupta, Managing Director of PNB Housing Finance, Real Estate on this show. And there has been, of course, the big issue, the big question mark in everybody's mind. 2 or 3 questions. Will property prices come further down? Will interest rates come further down? From an investor's point of view, the big question is, will this market, will the real estate market revive? Because there are a lot of people who've invested. There is a huge amount of inventory sitting there, project delays. So before I get into the specifics of the loan side of it, I want to get your perspective of what's really going on in the real estate sector according to you.
Okay. Vivek, let me tell you, the fundamentals of the economy are very strong. So there's nothing wrong in the economy as such. What's gone wrong is the sentiment of the people that they are not transacting when it comes to capital assets. And obviously, at an individual level, a home is the largest asset which anybody buys. There are 2 major segments which have a mismatch of demand and supply. One is the luxury segment, and this definition of luxury, etc., will change from city to city. So if you were to take, let's say Noida, where we are sitting today, what I would call luxury is, any dwelling unit which is more than 1 crore or 1.25 crore. There, yes, the supply has happened and the transactions are not happening. The other segment which is really reeling under and the shortage which keeps getting reported is the lower segment. And the houses are not available, there's a pent-up demand, and you have a big contrast there, or a paradox, that DDA allots and people want allotments to be cancelled, because the right product at the right place and with the right price is very difficult for people to fathom. But the mass housing, so for example, in this sort of a locality, anything which is, in between 45 lakhs to about 80 lakhs is selling and has sold well even in the last 2-3 years. So what I'm trying to say is the mass housing is moving. Luxury is slow, the supply is there, the demand is not there, because the sentiments are very low. And at the bottom of the pyramid, we don't have the right sort of units at the right location, right price, and the right design. So there, there's a pent-up demand which we keep hearing, 25 million houses to be supplied by 2022. So there are mismatches. So segment to segment, the velocity of transaction is fluctuating, and from city to city.
Right. If we look at 2015, Mr. Gupta, we saw a fair amount of rate cuts coming in from the RBI. Now, of course, one can argue that these were not enough, but we still saw about 125 basis points through the year. Not all of it, in fact, a small part of it has got transmitted to the end consumer. Why has that happened, and do you see that changing going forward in the next few months?
Okay, let me be very candid. I will be talking of housing finance.
Yes, I'm talking about the home loan.
Now, what happens is that the transmission, the RBI rate cut takes time to transmit. A very big factor is the liquidity, which today you are reading in the newspaper, everybody is saying that liquidity is tight. So the Keynesian theory of demand and supply also works when we are raising funds. So what has happened is that no doubt that the RBI has cut rates, but for us, where the raw material is money, and his debt, that has not come to our shop. So I would be candid, from last year March till, let's say, January of 2016, in the 9 months period when maximum repo rate cuts have happened, what we have visualized is about a 40 bips cost of fund coming down, which we have transmitted to the customer. Another very important thing is that, we have to do our asset liability matching. That long-term debt is not available at reasonable cost. So if I am offering a 30-year loan, at least I should be raising 10-year debt. So I can revolve my debt 3 times while my individual customers are repaying the loan. But I can't be raising let's say, a commercial paper or an ICD, which is an overnighter, and lending 30 years. I will be adding to the systemic risk of the economy, which would not be prudent on me, and nobody will let me do. So I think that 2 very important factors is, one is the repo rate and the other one is the liquidity. So the liquidity should be assured to the lender so that we can sort of borrow more and more as the credit offtake happens. And I think it takes some time.
Right. One of the trends we've seen of late is the fact that there are a lot of developers who come out with very high decibel announcements in terms of subvention schemes, in terms of zero interest, etc., etc. What, according to you, should be the basic factors that a consumer should keep in mind so that you don't end up going and burning your fingers by seeing some of these schemes? I'm not saying they're all dubious schemes. Some of them may be fairly genuine. But if you could just list out the set of things that a consumer should be careful about.
First and foremost, a very good question, because all these, I would say, USPs are coming out. They are more of sales schemes. From a customer point of view, a customer should check the past delivery record of a developer. So that is the brand reputation, I would say. Then on that particular project where the subvention is being given, you should check the pace of construction, and you should watch, because this is a very lucky time, because the menu card is long. There are a lot of supply which is there in the market, and there's a lot of time that you are getting. That construction on that particular project is happening or not happening. And there is nothing wrong to avail of a subvention scheme, because even a developer today is giving you a very, the rates of interest are very low. They're very reasonable. So he is just sort of paying you for what is, the cost of, let's say, booking a flat till the time it is possessed. So I don't think there's anything wrong in going ahead with a subvention scheme, provided you have done your due diligence on the reputation and on that project.
In fact, that's a very important point you've made, Mr. Gupta, because I think a lot of people have in the last 3 to 4 years really suffered because they've gone, booked a property, and we've seen the numbers out there. There have been so many project delays. And I want to understand from you, what's the kind of a role that a housing finance company can play in helping consumers to, before they make up their mind on choosing a project? I mean, have trends changed on that front? Have lenders, so to speak, because they are institutions, right? Their ability to know who is likely to deliver on time or not is probably better than an individual's. If you could tell us something.
I really wish that, the end customer first takes an advice from his or her lender. Unfortunately, that is still not happening. By the time a consumer comes to our shop, he or she has already contracted and paid their own contribution. So you have already committed yourself. And then, so we are basically playing a neutral role. Now, yes, if the community starts coming to the lending houses or the lenders, we can play that role of advising. So supposing if we are running, let's say, a scheme for 20 odd developers, we also have our shades of black and white, between those 20. We know which project is on time, which is getting a little delayed, which is seeing a sales velocity. Because mind you, a developer intentionally will not like to delay a project, right? So if the sales velocity is slow, the cash flow is slow. He is not going to endlessly spend money from his own pocket. He's not going to sell his home silver to complete a project. So that sort of advice we can give. I wish that happens.
Okay.
Yeah.
We also have a question coming in from one of our viewer. This is an email that has come in from Lokesh from Pune. He writes, I have a home loan account with a housing finance company since the last 8 months for 60 lakh rupees. The tenure is 15 years. I made a prepayment of 40 lakh rupees in October of 2015 from my own money through sale of a different property. I was forced to make a penalty payment of 2% plus service tax on the paid amount. As per NHB guidelines and Supreme Court case, there should not have been any pre-penalty charges, yet I was compelled to make the penalty payment. Now, we don't know the specifics of his case to that extent, but as a principle, if you could tell us a little.
What happens is that this prepayment charge is a regulated charge in our case, by the National Housing Bank. Now, what happens is, if it is an individual loans, nobody is supposed to charge any prepayment charge. But I mean, the gentleman has not mentioned if his or her company is also one of the co-applicants or the sources of payments are happening from the company account, then we are supposed to be charging a prepayment charge, right, as a housing finance company. So, I mean, I would say yes, as an individual, he should not have paid a prepayment charge. But yes, if his company, his partnership company or his private limited company is a part in the loan, a prepayment charge will be imposed for such an activity. Right.
Thank you very much, Mr. Gupta, for coming by and sharing your perspective with our viewers. It's been a pleasure having you on the show. It's time now to wrap up this edition of Money's Best Friend. If you have any queries related to equity, mutual funds, insurance, real estate, gold, then do write into us at moneysbestfriend@aajtak.com, and don't forget to mention your contact details. Goodbye. Have a lovely weekend.